Kitco Mining's special coverage of Gold Forum Americas is brought to you by Metalla Royalty.
Surfing the waves of risk. This is Paul Harris for Kitco Mining at the 2024 Gold Forum Americas in Colorado Springs. Joining me today to discuss this is Clive Johnson, President and CEO of B2Gold. Clive, welcome back to Kitco.
Hi Paul, good to be with you again.
Now, risk is all and ever present in the mining sector. You've been through the ringer a little bit this year, I think it'd be fair to say, but you're coming out of that strong. A couple of really big and important announcements last week. You just announced a deal with the government of Mali, under which the Fekola Mine will continue to be governed by the 2012 Mining Code and anything new under the new 2023 Mining Code. This has removed a huge overhang on the company, and your stock rebounded 13% on the day, which is one of the top 5 highest single-day daily gains the company's ever had, and I think the biggest one since 2009. How much of a relief is it to get the agreement with the government concluded and also to see your share price rebound?
That's a huge relief. You know, this has been a challenging year, and the situation in Mali, obviously as a public company, publicly traded company, your sentiment, everything sentiment. So the sentiment about Mali turned negatively when the Malian government said a year and a half ago they were going to come up with a new mining code. So the fact of the matter is that Mali's been a very good place to be a foreign investor in gold mining for 30 or 40 years. You can ask Randgold, Barrick, many other companies. It's been a good place to be. We've had a great success with Fekola, extraordinary success there in building the mine, expanding the mine. It's been great for Mali, it's been great for us. So a lot of market doesn't like uncertainty. Suddenly there was a question about going forward and producing in Mali. We've maintained all along that we had protections under the 2012 Mining Code that protected things like income taxation, ownership of the project, the rights for arbitration, and other factors, and the government acknowledged that in our discussions, in our negotiation. It hasn't been an easy path forward. We're trying to find a balance there. The government wants more from gold mining. Governments always want more from gold mining and other sources of taxation, but at the end of the day, it's trying to find that balance. So we've struck an agreement with the government, and it very importantly takes away that uncertainty. So Fekola itself is under the 2012 code. The expansion of Fekola, which we wanted to do last year, which is the potential to truck some weathered material from up to 20 kilometers away on the Fekola complex and truck that material down to the Fekola mill. That could very relatively good economics because you're not blasting the ore or crushing it. You're just loading it into the trucks and hauling it 20 kilometers to the existing mill. So the economics of that looked attractive. The economics of that still look attractive. That'll be under the 23 code because those licenses are exploration licenses. The government is now, with our agreement with us, are fast tracking the approval of the exploitation licenses. So we should have seen 80 to 100,000 ounces this year of additional production, which is one of the reasons why our production was down this year for the first time in a long time rather than growing. But that's going to come now next year. So we'll start trucking ore at the end of the first quarter of next year. So that gives us immediate growth of as much as 100,000 ounces a year.
And that's perhaps been a little bit of a benefit because producing that gold last year, you'd have received a lower gold price than you would get next year.
I like the way you look at the bright side of things.
Now
we've got to in our industry sometimes, but that's true. So it's been a very difficult year in many ways. Not only the fact of the negotiations and the impact in the market of the uncertainty, but we knew that this was going to be a difficult year because of things like we knew we had lower grade in the mine plan this year. We knew we had more stripping to do at Fekola. We knew we had some big capital expenditures, a new solar plant, upgrading the solar plant, new tailings facilities. So it was a lot of money to spend this year, and therefore for this year our production 870,000 ounces as a company, largely because of Fekola being lower for the reasons discussed. And looking forward, that all changes now as we get through it. So our costs have been higher than we're used to. They're going to come back down next year. And next year, you're going to see a lot of catalysts, including the trucking of ore, including Goose coming online and the mine in Nunavut coming online middle of next year, and underground at Fekola. And all the big expenditures that we had to pay are out of the way in terms of the Fekola capital. So a nice restart for us here. And we're back to growth again, which is, we're very excited about the future growth we have.
Before we talk more in depth about Goose, I want to stick with Mali. How do you see the future growth potential in Mali, maybe going out 5 or even 10 years' time, now that you've got this agreement in place?
Yeah, so we're going to be back at exploring the region as well. So we've had good exploration results on numerous targets, which is why we came up with this concept of trucking ore to the Fekola mill. So we're back at exploration now with the signing of this agreement with the government. So ultimately, we'll see how much we can increase the mine life of Fekola with trucking ore, etc. But also, we're going underground as well. but also down the road, let's see what happens in terms of additional opportunities. The 2023 mining code has got some much more significant taxation than we'd seen before. The question is going to be, is it economic? What are the economics of building a new mill, which we talked about potentially. We'll have to wait and see now what the economics of that look like. In the meantime, though, let's get trucking ore, and that'll expand production.
Okay, you also announced another cost increase at your Goose gold mine build in Nunavut in Canada, up to 1.5 billion Canadians. That's up 23% from the previous estimate. Your first estimate after buying it from Sabina in 2023 put the capex at 890 million Canadian. With the gold price up and the Mali overhang out of the way, it seems most investors have shrugged off that cost increase. Was that a surprise for you?
I guess a little bit. I like to think it speaks to the credibility of what we've done. The history of B2Gold, our predecessor company, and B2Gold, one of our great reasons for our success has been the ability to deliver. So we build our own mines, we've done accretive acquisitions, we build our own mines, we design our own mines, build them and run them. Very few companies do that themselves, tend to contract a lot of it out. And that's been our great success, is delivering the promises you make. This situation was a bit different with the Goose project, because the previous owner, Sabina, had decided that they would try and actually go to construction themselves as a single asset company with not a strong financial position and also a very challenging project logistically, technically in the north of Canada. They made that decision to pursue that on a standalone basis. So by the time we got involved, normally we buy a company in a friendly takeover where they have a feasibility study. We'll come and redo the study and then design everything ourselves, control it all. In this case, they'd already ordered a mill. They'd taken certain steps partway through construction. So we had to get on board and try and do due diligence to understand what was spent, what wasn't spent, etc. And there was a real time pressure because they were committed to trying to finance it themselves starting June 1st last year. We did the deal in April. So we had to make a decision to go for it, go ahead. We did increase the capital estimates from their feasibility study because they were very low when we did the deal. And subsequently, we found, unfortunately, certain things that were advertised weren't as promised. So we were supposed to have mining equipment on site so we could start stockpiling now or when we start the mill in the second quarter of next year. Unfortunately, the mining equipment was not up to speed. We had to junk quite a lot of equipment. There were things we found out later on that caused some of the cost increases in our case. That meant we had to extend the start of production, gold production, to the second quarter of 25 as opposed to the first quarter. But actually construction is on track for that first quarter of 2025. Now we've spent 66% of the capital requirements. Everything's on site to build the Goose mine. We're feeling very confident in this new budget. We hate to see you have to come back and increase our budgets. We really don't do that historically. This is because of the circumstances. If they had drawn down that financing in June of last year, a private equity financing with gold streams and prepayments of gold, a very expensive financing, we would have walked away forever because it was going to cost so much to finance the mine under those terms. So we got involved. We were able to not draw down the punitive financings and leave a lot of the benefit of the Goose project for ultimately where it should be, the shareholders. So it was a bit of a different one for us, but we really believe it's a great acquisition for us. It's geographical diversification, being back in Canada after 40 years. It's nice to be back. And also the Goose project is a very high grade, good deposit with tremendous exploration upside. And we got great relationships with our Inuit partners, and we're very excited about it. It's going to be a good project.
Now, Goose is going to produce 310,000 ounces a year for the first 5 years. The 2021 feasibility study that you referred to used a gold price of $1,600 per ounce. Obviously, we're way above that now. What are the potential economics going to look like at current gold prices?
Yeah, well, if you run it at 2,000 or higher in gold price, of course, you see the big advantage of that. In this, we're putting together a new mine plan right now, which will be out in March because we're doing a new reserve resource estimate based on additional drilling that we've done. And we're happy with the progress of that and how it looks. I don't see a significant impact in the kind of operating cost profile we were looking at before for the Goose project. So just because the construction capital cost has moved up a little bit doesn't mean that reflects necessarily into operating costs. So we're still looking at something we talked historically about, something around $1,100 an ounce of all-in sustaining cost. We've seen nothing to indicate we're not going to be in that kind of range going forward.
Okay, your stock is flat year to date, while some of your competitors are up 50 to 100%. With the Mali overhang out the way and with Goose, with the line of sight to the finish line, what do you view as the re-rate potential of B2Gold?
Well, the good news is we're starting to see it. So we're up about 25% over the last week. So clearly seeing that re-rating. I think we were way oversold. We lost about $5 billion in market cap, largely because of Mali uncertainty. excuse me, that's a hefty price to pay. The markets always tend to overreact. So it's really gratifying to see this week that the market has understood the resolution of the issues in Mali, more certainty there going forward, and the ability to expand, and also understanding the Goose project. So the bottom line now is we get to shift our focus to growth. Between trucking ore and Fekola, that has 100,000 ounces a year in the short term. Goose, as you mentioned, will add 310,000 ounces on an annual basis starting in the middle of next year. And then there's a Gramalote project in Colombia, which is at a feasibility study stage now, moving into feasibility next year. We've had that for a long time. We're very excited about the economics of that project to potentially add another 240,000 ounces a year. If you add those three together, there's 600,000 plus ounces of production growth potential for this company from existing assets. We don't need to find the ounces, we don't need to buy the ounces. We're very committed to realizing the benefit of what we already have. So that's why we're focused on growth. Nice to see the market starting to reflect that. And I think we're going to see ourselves recover very strongly here as the market figures out our upside potential. When it comes to things like M&A, you can see why we're not that interested, frankly, because we have 600,000 ounces of production growth that we don't have to pay for. We own it. At the end of the day, that's a hell of a growth profile, and we're in a very strong financial position to realize that. So I think this is a turning point for us right now. This has been a really tough year for the reasons we discussed. Now we transition back to what B2Gold has been famous for over the years, which is accretive growth and great returns to shareholders. So we have a $700 million credit facility, non-drawn, with a great bunch of banks. We will start drawing into that. We ended June at $450 million in cash in the bank. And obviously, the higher gold goes up, the higher cash flow we're getting from the mines. The mines have been running, Masbate and Otjikoto have been running extremely well. So we see ourselves well positioned to fund what we need to fund going forward. And also one of the things we do well is exploration. We'll continue looking for more ounces as well.
Now you're a give or take 1 million ounce a year producer. You're also one of the lowest cost producers on an all-in sustaining cost basis. As you mentioned, the issues such as Mali have knocked several $1 billion off your market cap. You're now, about $6 billion market cap. Do you feel vulnerable as a potential takeover target for somebody else?
Well, the best protection of a takeover is your stock price, your market cap. Is ultimately the best. So I might have been a little more concerned about it over the last 2 years. But it's a funny business in a way, and psychology is a funny thing, because the very reasons why our stock was down, uncertainty, people weren't buying our stock because they were uncertain about the future of Mali, our biggest mine. Somewhat understandably, they're worried about that, and also what was Goose ultimately going to look like. So those two things that caused our stock price to get hit hard and lose market cap value are the same reasons why they're effectively poison pills. Because anybody looking at B2Gold in the last 2 years would probably say, well, Mali's uncertain, I'm not going to take that risk, and they have the audacity to build a mine in northern Canada, which everyone knows is a disaster. This is not a disaster. So I think those are the reasons why people have not taken a run at B2Gold to acquire. Are those reasons. So the best protection is your market cap. We're seeing recovery now. We will never be entrenched management. B2Gold was taken over by Kinross, which is not what we wanted back in the day. Between that $1 billion deal, we work for our shareholders. If any reasonable offer, it's the shareholders' decision, not ours. So we're open to whatever makes sense going forward.
I think it makes a lot of sense what you've just said about the reasons for a company not to take a run at B2Gold, but now they're out of the way, and now you're at the start of the recovery. Would now be the time for somebody to take a run at?
Perhaps, but at the end of the day, as I said, our job is to build the company back up and continue to grow this company. So when you look at the production profile going forward, I guess I would say if someone's going to take over B2Gold, they better come fully armed with a lot of cash, most probably, because I can make a very strong argument to existing shareholders. There may be an offer on the table. Do you want to take that offer, or do you want to let this very successful executive team continue to run this company? We could make a strong argument. If there was a takeover offer that we didn't like as management, we could take it to the shareholders, but make our point. Do you want us to stick around, or I guess we could go and do B3 potentially down the road? So I don't spend my time worrying about that. I spend my time worrying about things that we can resolve.
Let's broaden the M&A conversation, Clive. As the gold price rises, companies are becoming more profitable. They've got more cash to spend or to allocate to different activities. Do you expect M&A to heat up in the space, whether that's consolidation or bigger companies building a pipeline through buying smaller companies?
Yeah, I think it's a real dilemma for the industry. The investors want that. They want fewer mining companies that are the better run ones. We've seen some of that. But at the end of the day, if you're looking at an M&A today, what gold price do you use? And it's going to be competitive. Newmont came out announcing they're going to sell a bunch of their assets after their big merger. We didn't sign up to say let's get in the data room. We just felt there's other companies that need M&A more than we do. We've got this growth profile, and we haven't overpaid for things. So for us, we're sitting on the sidelines in this one for now. Let's see what happens. But I do think M&A is coming, but what gold price are they going to use to justify to the shareholders, and what are they going to pay? That's going to be the interesting question, and how much we see. It'd be good for the industry, good for the investors to see good M&A, less companies, the better run ones. I think it'll be in the future, but it's going to be interesting to see how that pans out.
A lot of investors invest in gold stocks because they want exposure to the gold price. And yet a lot of gold companies store cash on their balance sheets rather than gold. Should they perhaps rethink that?
Well, we think we can do great things with the cash we're generating, whether it's paying a 5% yield dividend back to our shareholders or whether it's growing the company, because we have such a successful track record of growth. So I think in our case, we're exposed to gold, we're exposed to the upside, downside of gold. We're a gold producer. We don't play games around gold or store gold. Basically, we're there to sell gold at the spot price at the time and look to continue to grow, maximize production, and look at new opportunities. So I think we're obviously extremely leveraged to gold. If you imagine gold price going up a lot from where it is today, imagine what the impact that would have on the successful gold producers. The cash flow we'll be making goes up so much with a rising gold price. A lot of people think they want protection, so they want to buy physical gold. I would suggest that if you really want to maximize your opportunity if gold goes higher, buy the gold producers that are successful, because those gold companies, percentage-wise, will dramatically outperform the increase in the gold price itself. If you believe in financial Armageddon, at the end of the day, ride the producing gold companies up, then sell them, and then buy bullion at the end of the day. But there's a real great opportunity of leveraging the successful producers like ourselves, who are going to make so much more cash flow as gold goes up. So I think that we're happy to be in that position, but very solid position. If gold were to go down, we'll be fine as well.
Now, until the past couple of quarters, B2Gold was a very low-cost producer with around, let's say, $1,000 per ounce, all-in sustaining cost. With some of the issues out of the way, as you said, you expect that to now come down. In terms of your capital allocation strategy, will that see you increase exploration, increase your growth expenditure? You mentioned the dividend the company pays. Any thoughts of potentially increasing that?
We'll look at it as we get through now. We've just got a resolution to the two major issues. What is Goose going to cost to build? And also what's going on in the future. We'll look at our we always look every quarter at our capital requirements going forward, and that's when we look at things like the dividend to adjust. The focus now is on growing for these existing assets, as we covered. We'll continue to invest in junior companies. We see great opportunity there. So Snowline, which has a major world-class discovery in the Yukon, we identified that pretty early, went to them and said, if you're looking for a big brother friendly shareholder, we'd happy to be involved. So we own 9.9% of that. I think that's an important role we can play in the sector with the inexplicable lack of support for junior exploration companies with a higher gold price. Now, if you're looking for gold but you don't have any, the gold price doesn't really help you. You're the last ones to benefit from higher gold price exploration. But we see opportunity there, and we see opportunity for ourselves to help those juniors and also have lots of different toes in different bodies of water, I suppose.
Now, you mentioned the Gramalote project in Antioch in Colombia. Feasibility is due to be published mid-2025. In the PFS, if I recall correctly, the IRR was somewhere between 15 and 20%. At current gold prices, I imagine that's going to be much, much higher than that. How exciting is that project looking for you?
Well, I think it is, and it's an interesting history, very exciting. And the interesting history of Gramalote is we've been involved with it for a very long time. And it was a joint venture between AngloGold Ashanti and B2Gold. So over the years, it's had numerous feasibility studies done, but we were always looking for a big mine because you have two significant gold producers sharing the production. So something like 200,000 ounces from the mine wouldn't have been interest to the two partners, 100,000 ounces each. So we always pushed for a bigger mine, lower grade, big mine, big capital. So we reached that point in feasibility where we turned it down to build it. So did AGA. There was a positive IRR, as you mentioned, but we felt that given the large capital expenditure, we weren't going to play. Neither was Anglo. We bought them out, $20 million up front, another 40 if it becomes a mine. So pretty cheap acquisition on that. But at the end of the day, what it does is, for the first time, lets us look at it as one owner. So we don't need 350,000, 400,000 ounces of annual production. How about 240? So that's what the feasibility study, the PEA said, and that's what the feasibility is pointing to. Now, it's always had pretty low all-in sustaining costs, less than $900 an ounce, which is very low these days. But the key point has been the capital. So we're going to have a smaller project now, less footprint, very attractive to the locals. The governments have been very supportive. We had a mining construction permit before. Now we're modifying the permit. So we like it a lot. We liked it at $1,800 gold as a standalone with one owner. We like it a lot more, of course, with higher gold prices. So I think that's one that it's not as certain as Goose is or the expansion of Fekola, but we've done a lot of work on that. I think that's going to be a very good project for it. It fits in really well with our construction team, finishing Goose and then potentially going to Colombia to build Gramalote.
$60 million for that does seem to be a very, very good deal.
If it becomes a mine, it'll look like a pretty cheap acquisition.
Okay, how do you see B2Gold? Where do you want B2Gold to be in sort of 3 to 5 years' time?
Well, I think the potential obviously is the short term is these, as I mentioned, 600,000 plus ounces of production from existing assets. And of course, some of the mines are going to be declining in that period of time, so it's not a direct on top of what we're producing today. I mean, we're very open to continue to grow the company, which we've done so successfully. But I'm really always hesitant to say we want to be 2 million ounces by this date, or you can't control the time frame of opportunity. So we'll continue to let's get credit for what we have. Let's look at M&A at the right time, and let's continue to find ounces. The cheapest ounces are always the ones you find. We found a lot of ounces around the world.
Well, Clive, congratulations on hitting a couple of big milestones this past week. Clive Johnson, thank you very much for joining us today.
Thanks, Paul. Always a pleasure.
We have a lot more to come from the 2024 Gold Forum Americas in Colorado Springs, so hit that subscribe button to see all of our videos. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of Gold Forum Americas is brought to you by Metalla Royalty.